All right, good morning, everybody. It's Friday. We made it. We did the darn thing. So we're starting to fade back a little bit. Earlier this morning, all of this was green. Hong Kong kind of leading the way to the downside, 1/4%. NASDAQ in the red, but just barely. S&P flat, and then the Dow small caps are up the most, but still headed to the downside. Just pulling back more than anything else. And then Europe still positive. It's been a wild week for sure. We can see that there's no big market events, market watches that go to if you're just looking for the biggest ones and you don't want to get caught up in the noise. But if we go to FX Street, you can see there's events going on. They're just not considered big enough for the market watch page. Got Canadian job numbers. And of course, everything's been about jobs last Friday and this week. We've seen the markets move quite a bit on job numbers. Should be a quiet day, going into the close with the market just really trying to catch its breath after a wild move. But we're back where we started, really. That's kind of the biggest takeaway. This is the view on the week. It's a significant pin bar. And, we had started to talk about the pullback when it first began and how we were due for that regular 5 to 7% pullback because it's a good healthy thing if you're going to maintain a good healthy market. But for a number of reasons, the move picked up to the downside really fast. And instead of getting a 5, 6, 7% pullback, we got 10.5. It still doesn't take away from the fact that we're looking at just a typical regular pullback. The reason that bar is hollow, even though it's red, is because the current price is higher than where we opened, but it's still lower than the previous close. So this is what we call trend candles. They'll change whether they're solid and green or hollow and green, solid and red, and hollow and red based on how they opened and closed. So considering where we opened on the week, we are up above that open, but we're still below where we closed last week. And there's a lot of metrics and a lot of resistance overhead. If it's going to be the same pullback as before, we got to expect that there's going to be a lot of the same issues as before, right? You can see the last time we had this good of a pullback, we spent 2 weeks inside that last downward candle. And we finally broke out of it after the third week, right? So we were IX10 or inside week. And then we finally got the breakout. When we came up and retested the high, we spent 2 more weeks sideways before we finally started to get that breakout. And it was almost a month later before we closed out of that range. So another IX10, another sideways. And through all of it, we were inside this zone, right? That pullback area. And it was a smaller pullback area, 6.85%. Our area for the pullback this time, it's much bigger, 10.5%. We could spend months trying to get back to our previous high and get actually closed above into a new high. It's already August. So we could spend the rest of the year underneath this high, and it still wouldn't be necessarily considered bearish, because if we're not setting new lows and going lower, then we're not bearish. I bring this up because I've been getting asked quite a bit, hey, is it time to get back in? Should we be loading up in the portfolios? I mean, sure, there's always something making some good moves out there, right? If you want to shop around and see what's making moves. But if it comes to the idea of trying to go long SPY or, long the Qs, there's a lot of evidence that says we're not going to just run right back up to the top and go. Sure, we brought the week back up to last week, so it looks really bullish from that point, a good 200-point move back up. But that's just getting us back inside the range that we need to be in to be considered healthy and not unwind and crash and burn. So a couple of things that you can focus on even without indicators yet is just a halfback level. Measure the highest point of the pullback to the lowest, mark that halfway point. We can also do that for just last week, and that gives us a halfway point. Once this current week is done, we want to see what price does next week, if it's going to hold inside the range or if it's going to continue moving to the upside. Remember the last time we spent 2 weeks inside the last low bar. Well, this week, hopefully, is the last low bar. So how many weeks are we going to spend sitting inside of this thing before we finally get out of it? And even if we do close inside of last week's range, are we going to be stuck inside of that one? So I would temper my enthusiasm for longs in the indexes and instead focus on the equities. There's a phrase that says it's a stock picker's market. Sometimes that's true. Sometimes, you can just close your eyes and pick a name and everything is doing the same thing, right? Everything's going up, everything's going down. It makes it really easy when everything is doing the same thing. Everything is not doing the same thing right now. So you need to be very particular about what you pick. But I don't think the indexes are going to be making significant rallies back up to old highs and breaking out unless something changes on the macro front, right? So we are back above the put wall. I'm still waiting on the founder's note this morning for the AM edition. But just the fact that we're holding above that put wall, that's a good start. And from what I read last night, that puts us in a yellow state. If you read those spot gamma reports, they talk about how you got your green light, your yellow, and your red. Well, this puts us in a cautiously bullish, optimistic position, right? And it's cautious because we're above the put wall, but we're still underneath the volatility trigger and the zero gamma. If we keep testing this put wall, I think it's going to give out on us and we might test these lower levels again. But for the week, we've still got our range. And we broke out of it this morning in the Globex. But we weren't able to keep it and we faded right back down again. So now that we've got a high set here, it's the new high that we have to get through today to continue any sort of move to the upside to get through the volatility trigger and the zero gamma. If we were to focus on where the sell zone would be, using the 111, we got to get out of this range because this is where all of the liquidity is at. And really, we can back that up a little bit. We don't always necessarily have to use the highest point, which I've talked about before in my fib videos, but I kind of like that spot with this high because it lines up with this close. It's not dead on perfect, but kind of gets us to the point. So I like this right here, and this shows the sell zone is doing its job. We came up into that liquidity. We weren't able to absorb all of it at one shot, so we faded back down. But now this low on the put wall becomes really important. When we test into liquidity like that and we fade away, we don't want to retest the lows again, right? When you pop up into liquidity, if we're still going to stay bullish, then we pop up into it, we try to absorb some of it, fade out, and come right back in for another shot. Unlike back here on Wednesday when we popped up into it and we ended up heading all the way to the downside before we found anybody willing to step in and pick it back up. So far, that's the difference between Wednesday and today. Is that when we got up into this zone, we haven't just dumped afterwards. And if we were going to back this up, it would be putting it back where it was when we got into that area on Tuesday. And this is the sell zone. And we're still in it. All right, this is really noisy. I turned on the SNR levels for a moment just to see how far away they are. 54.15 is the upper one and 52.36 is the lower one, but I'm going to turn those SNR levels off. They're just too noisy. That cuts us down to just these two pivots, the weekly pivot and the daily pivot. For the daily pivot right now, we haven't hit that daily pivot yet, so it's an MDP, missed daily pivot. The pivot has a channel around it, call it a CPR. It's a central pivot range. That central pivot range is touching or overlapping yesterday's range, but it is higher than yesterday's range. And it's really wide like yesterday's range. Generally speaking, if the channel is wide, we have an expectation that the market really won't expand or break out, that breakouts won't stick and that we'll come back in again. Now, these channels don't make price do anything. So it's a perception of what we expect price to do. When we have a positive gamma in the spot gamma index and we have a really wide channel, those are two different metrics that are both telling us breakouts shouldn't stick and that we should come back in again. We want to play mean reversion strategies and not expansion strategies. Problem is, we're not in a positive spot gamma index. As of the close last night, it was still at minus 3.28. It only goes from a -4 to a +4. So if we're at minus 3.28, it's basically 3.3. Well, that's really close to as negative as it can get. And when it's negative, it says that breakouts can stick and the markets can make exaggerated moves in either direction. So right now, we want to continue to focus on 52.98. If we break our own Globex low, then it's very likely we're going to test that floor pivot this morning. It would be underneath the round number, so we'd be looking at an overshot into liquidity right into the pivot point. We don't really have a reason to expect that we're going to break our own Globex low at this point, but that would be the first target. Once we get through the floor pivot, we have 52.71 as the half back from yesterday. So it would be 52.98, and then there's a cog line 52.91. Then there's the half back 52.71. These are the ADR levels. They tend to be pretty useful on a day-to-day basis. I mention them constantly, and I was surprised yesterday when I had a lot of people asking me, what's that ADR thing that you're talking about? Because I called this level as our price target about 9:45 yesterday. That was where we were going on my call out. As long as we continued this drive to the upside, that was the target. Not too bad, right? I missed it by 7 pennies. It looks like we hit it, but just I missed it by a little bit. I use these constantly. If you haven't come across these yet, or you haven't heard me talk about them yet, then, well, hi, welcome to the morning briefing, because we look at them every day. So there's no magic to those things. They're just math. You can see in the upper left corner of the screen, 21-day ADR. ADR is average daily range. It's a 21-day average. We're looking at what the market does on a day-to-day basis, how far it goes. Right now, the average range is 104 points. So if you see me posting about these levels and I say it's an ADR half, it's the red lines. If it's an ADR full, it's the yellow lines. The reason for that is if it's a 100-point range from the Globex open, we could go 50 points up or 50 points down, and that would be our 100-point range. So ADR half, we're splitting the difference half and half. On the other hand, from the Globex open, we could just run 100 points in one direction or 100 points in the other direction. That would be an ADR full. I share the indicator for Thinkorswim in my Thinkorswim workbook where all the other indicators are at. If you're using TradingView, just search for ADR or average daily range. It's not mine that you'll find because I don't have a published indicator on TradingView, but you will find one that comes really close to this one. The numbers may not be exact, but it'll be pretty darn close. And that's all that counts, right? Because you're not going to trade to the penny anyways. It's not about perfect. Right now, we haven't hit either ADR line, and we're basically flat on the day. Well, that's a coin toss at this point if we would hit either one first. Usually, we're closer to one side or the other, and so the bias is that we're likely to go ahead and hit the one that we're closest to first before we do anything else. Since we're in the middle, really 50-50, go either way. In fact, since there's no economic events large enough to be on the market watch page, we could just define our entire day within the two red lines. If we don't have any reason to move, and after a significant recovery, and considering that we've stalled out here, we could spend the rest of the day within this red range and not do anything into the close. It would be considered a win on the week. Just the fact that we were able to climb back out of that mess and hold the line without continuing to break down, this would be a win. So I wouldn't get your hopes up for, a really good Friday close where we make significant moves like we did yesterday. Now, having said that, don't think that we can't get a second day where we get a really big move. I know it's easy to say, oh, we've already made a big move yesterday. We're very likely going to pause here and digest. But we can make another really big day. And one of the reasons for that is shorts. If there's a couple of firms in this low volume environment that want to continue to push this and we get some 0-day activity that continues to drive it higher, and everybody else is thinking, oh, it's probably going to fall. They load up with shorts, get run over. They have to cover their shorts, so they're buying. That adds to the buying. Most of the trend days that we get, like Wednesday's move to the downside or Thursday's move to the upside, most of those continuation trends are based on that same logic. People are trying to go the other direction. It doesn't work. They have to cover. That cover adds to the move, and it continues to push. It's a little bit different logic than, say, swing trends and trends on a weekly, daily time frame. Intraday is its own beast. So the tip on that little tangent there is to watch the flow today. So if we get a break and a move, it's very likely going to be from that. And there's one thing that's kind of holding me up here, and that's the market maker move. They're hedging this morning. Well, we just went through the news and there wasn't anything on there that would say that they should be hedging. What, Canada? I mean, yeah, eh? Maybe. That's all we got. So it's not a question of are they hedging, because we know for a fact that they're hedging. It's why are they hedging this morning? It may be. That's true. It could be. Global events could be causing them to hedge. I did see that Japan issued a mega quake warning. That's a new word to me. I don't know what that means yet, but that was announced right before I started the stream. So they could be hedging because of some global events. This is a weekly profile. Is interesting. I was talking with somebody yesterday. Their weekly pivot point was not in the same place as mine. And so we compared charts, and he was using his profile set to a week, kind of like this. But I think he was on the weekly chart. So his number was different than mine. Be careful with it with different brokers and different profiles. It's not that you would do it right or wrong, because it's not really about doing it right or wrong. Just be consistent in how you use it. And if you're unsure, check with somebody else. Make sure your numbers are matching what everybody else's numbers are. It's easy to inadvertently change a setting and get it all out of whack. A point of control is just where the greatest amount of volume took place in the time frame that you're measuring. And we're measuring from Sunday's Globex to our current moment. And all of these past ones were from Sunday Globex to Friday at 4. So the red line down here, which is kind of hard to see, is at the cog line, 52.32, and I'm rounding. It's not spot on right there, but a break to the downside, we have a lot of structure underneath us. We got the 53.32, and then 53.11, 5300, 5292. Kind of get the idea. We got a lot of levels, but also way down there is 52.32, point of control, and the cog line. So some credit spreads around these lows, or even just, short puts on ES and MES, since they require much less margin than puts on SPX and SPY naked. It's not really a bad idea, and they're easily defended since they're naked puts. We still have this volume structure. It's a high volume node. It's the same level that we were talking about Wednesday as a significant area that we've got to work through. It's not the point of control of last week, but it's still a pretty big level. If we can get through that, 5450's got one. So we still have that drama to deal with for a move to the upside, which kind of helps lean into the argument that, it's very likely we just don't do anything today and we just go sideways into the close. I posted a picture earlier this week that said we got to get back above this 20-week moving average by the end of the week. We got to get back inside of last week's candle by the end of the week. So we're there, we're back inside, just barely though, right? We're not by very much. 53.32 cog line is the low basically, and we're there, right? That needs to stick. So for a healthy close, we need that. We do have the cumulative volume index pointing back to the upside again, and on the weekly, it's good to see that. But the week isn't done yet. And this is the candle that we talked about earlier in the week on all of those other examples we've had in the past, where we get a big move to the downside, and then we get that capitulation low, flip, and rally back up. Now, the rally back up on the daily, it bounced on the 200 and made the move up, but it was a bit disappointing since we didn't cross through our own open and close higher than where we originally opened. There's a lot of really great examples of these flip days, these capitulation lows, where when we do flip and rally, that it's so strong that we make it through our own open and actually have a green day. And I showed those on the morning of that really deep drop and what we were looking for. We were hoping for something that looked a bit like that. Start the morning really negative after multiple days of being negative. We fall a long ways, and then we flip, run it back up to our own open, and then go even higher from there. It wasn't that good. And you'll find a lot of those examples if you go looking in the past at the S&P. So sure, we flipped, we've run, but as I've been pointing out all week, we still have this issue, right? This is the last low day. Candle at the high of low day, right? CAHOLD, CAHOLD. It's an old acronym from TD Ameritrade. Connie and Ken and all those guys used to use that. So we got the close out of the box. It's a good start. We need to keep it. We want to monitor yesterday's levels, like the half back, close above it. We need to get this close on the week inside of last week's range. And right now that 53.58 is the gap close, which it's been closed. That's not the issue, but we got to close above that level. The next have to in a whole list of what we have to do. So I mentioned their hedging. This isn't my opinion. I'm not guessing and assuming that they're hedging. We know for a fact that they are hedging this morning in the futures. When the firms trade a boatload of SPX, they hedge it with futures. right? That's how the dynamic works. We can see the market maker move tag this morning, so we know that they're hedging. The market maker move tag there, if you go to the trade tab, it's right here. If there's no market maker move today, then that just won't be there at all, which is unfortunate. They should have at least left the tag there and just have it say 000. Because I get people asking me, hey, how do I turn that thing on? If it's not there, it's just there is no market maker move today. So what it's measuring is the front expiry, which is the 0 day. Notice I scrolled a little bit. The negative one is still here. Just ignore that. It'll drop off in a little while. It's looking at the 0 day and the next expiration out. If the implied volatility average in the front is bigger than the one behind it, then you have a market maker move. It's as simple as that. I've heard some really smart people and popular people get this all wrong and screw it up, and just that's what it is. It's as simple as that. Now, why does that mean that they're hedging? Well, this is an implied volatility average. And while they won't tell us the entire formula, they said it's proprietary, and they don't want to share all their secrets. Every broker gets that number in their own way. We know some of the components. It's using the square root of time, so how many days we have left to expiration. And it's using the implied volatility on the out of the money options. That's one of the key words there, out of the money. So the implied volatility average in the out of the money options, all the puts, all the calls that are out of the money, they add up this implied vol, then they get an average from it. And that's where this number comes from. If they're hedging, like we can see this volume in here, 2,000 on that one, 2,500 on this one. If they're hedging, it changes the vol, because this vol, this implied volatility, it's not the same as your candle chart implied volatility, right? On a candle chart, it changes as the candle closes, like historic vol, distance from candle close to candle close. Well, we're in the options chain. What candle, right? What close to close are we looking at? So this implied vol changes based on the scope and the pace of the trading on the option itself. The changes in the options price, how many trades have taken place, how fast those trades come in, that's what changes this implied vol. Well, when they're in there hedging, they jack up the implied vol and the out of the money options. It increases the implied volatility average on the side. It triggers a market maker move signal, and we know that they're hedging. Hedging is cost. If you or I do it, we can probably make, a break-even trade or a no-risk trade. When they hedge, it's cost. That's all it is, right? Turn on the fireplace, grab your wallet, throw it in there. It's cost. They won't do it unless they have to. Penny pinching. They'll pinch that penny twice, right? So the only reason that they're going to hedge is if they think they need it. Well, what the heck is on the table today that they need to spend money on a hedge? That's the question, right? Usually we know the answer to that, by the way. It'll be CPI, non-farm payrolls. We already know why they're hedging. We don't know why they're hedging today. It could be geopolitical. I don't know. But the fact that we don't know should provide you with a little bit of caution. We know that they're hedging, even if we don't know why. And so proceed with caution. These are the VIX futures going from August, September, October, November, and December. The front one is sitting at 22. And if you go out to October, I think it's October, we're also sitting at 22. So they're scattered now. The other day, it was a very clear signal of backwardation. Now we're starting to normalize a little bit in October, but say like December, it's still lower than our current levels. So it's still muddy. If you don't have the VIX futures, you could use VIX 6M, 3M, and then the VIX itself, which is 1M, 1 month. Somebody said the other day, why are you using the futures at all? The futures are traded, right? So that's actual money and traders giving their opinion based on their wallet, right? Put your money where your mouth is. Trades move the VIX futures. Math moves the VIX, VIX, 3M, 6M, right? That's just a formula, a math formula. That's not traders putting their money down. So, you know, if you want to see where the volatility is, look at what traders are actually trading. Ten-day, 30-minute volume profile. We're back up to the level we talked about earlier this week. It's very likely going to be the new point of control, especially now that we're back to this level and building more volume out here. The point of control right now is still 5,500, but we're expecting it to fall away from that level unless we rally up there before it falls away and we put more volume there. If we do that, then of course it'll stay there. But next week, we're going to lose all these candles on the left. As we lose those candles, this volume shelf is going to slowly dissipate. And this one will be the next largest area, and that'll be where the point of control goes. So if we do break to the upside, keep that 5,500 in mind. It's where the point of control is, and that just means it's where the greatest amount of trading took place. And you can approach that however you want. Maybe it's resistance, maybe not, but I always look at it like this. If there was a boatload of people willing to trade there when we were there last time, and now they find that we're back there again, we're going to expect that they want to trade again. Look at it from your own point of view. If you got in at 5,500 and here we are a week and a half later, we're back at 5,500, what are you going to do, right? You spent all that time and we're right back where you started. You'll probably do something with your trade, right? If you're long, maybe you get out. If you're short, maybe you get out. Well, that's trading activity. That's all I'm saying. Look for trading activity at that level. It very likely will become a resistance because of that activity, but we don't even have to call it resistance at this point. In that move to the upside yesterday, we got back into the point of control from Wednesday. So we're done with that one. We can take it off the table. And then towards the end of the day, we almost hit this VPOC from last Friday. Almost. Maybe we missed it by a couple of ticks. But we hit it this morning. So we're done with that one as well. The VPOC is just a point of control that has not been hit yet. Right now, the textbooks will tell you to carry forward the point of control and the value area high and the value area low each day, right? So like we would mark those levels on today's chart from yesterday's price. I don't, because I've already got enough pivots. I don't need any more pivots, but I will mark a point of control if it hasn't been hit in the next day's trading. We still have one to the upside, 54.72, which is in our road if we're trying to go to that 5,500 level. We don't have one from yesterday because if we look, that's the point of control, and price came down and hit it around 8 o'clock. So it's not untouched. It's already been touched. It's already been hit. I don't want to mark it. This is a really tight range this morning, and the profile just kind of shines a light on that for us. As we've talked about before, tight ranges are where markets gain energy, right? I know that's an odd phrase to use, energy, but the RSI Laguerre showed us that markets can gain energy when they're going sideways. Not just can, they almost always do gain energy when they're going sideways. We've got next week's expected move on the table. It's not set in stone yet. These three lines are going to continue to move through the day. And at the end of the day today, where they're at will be locked in stone. They won't move again. So if you look in the past, all of these lines, they don't move anymore, right? Those are just old weeks, old levels. But through the day today, these lines are going to shift with price. The gray one, that's our current price. And then these two are a 1 standard deviation measurement. It's next week's weekly expected move. Now, once it locks, I call it static. It's a static expected move. It isn't changing. It's not going to move. It's not dynamic. So every day we have an expected move. You want today's expected move, you can just go in and see what today's expected move is, right? 52.5 points, plus or minus. That's today's expected move. But we want a 1 week expected move, and we're going to lock it into place. This weekly expected move gives us some idea of volatility and how it's changing. Well, we can look at our current week's range, and we can compare it to next week's range and ask some basic questions like, what's the volatility look like for next week? Now, since this volatility comes from the options world, if they're doing a lot of hedging, then this range will widen. The market maker move is just telling us about hedging today. This range is telling us about next week's range. If they're bidding everything up into next week, we'll see this range get wider. If there's less volatility next week, the range would be smaller. Well, I just put the box on there, and I'm not trying to be spot on perfect with it, right? This isn't an engineering focus. Just throw a box on that thing, lay it over the next week, and see what's it look like. It looked like it was about the same. So if you liked this week's trading, buckle up, baby, because it looks like we're going to have another week of it. Not for the futures, but it's a good question. Now, maybe as we get really close to the end of the contract, that's possible, but no, open interest wouldn't act as a magnet in the futures. And really, even for options, I mean, back in the day it did. And, you know, things like that big, what was it? Is it Fidelity's big SPX collar straddle trade? Some for a while we're saying that that was a magnificent pinning mechanism, but we don't really see a lot of pinning metrics anymore. But I certainly wouldn't look for it in the futures. Too many competing interests, right? Especially with how they're using the futures or why they're using the futures. What's wrong with this? Oh, okay, never mind. I was thinking my VWAP is out of line, but that's not VWAP. It's some kind of major moving average. The anchored VWAP, if I remember right, I took it off of Thinkorswim because the anchor is acting weird, right? It's they haven't fixed it for contract changes. What am I doing? So we'll just throw it on here for a moment, but I'm not expecting to see any improvement. The year-to-date anchored VWAP on Thinkorswim has this disconnect, and if you want it to match, you have to set your chart to not adjust for contract changes, and I don't like that. So I've been going over to TradingView, and I've been looking at their anchored VWAP because I want my chart to continue to reflect the adjustment for contract changes. So that's why it's not on here anymore. We're still below the 10-week, and we've been kind of holding the line all week. Notice on previous examples, once we drip down, we usually pop right back up again. And we didn't. We've just kind of held this line. It's still healthy because we didn't continue to go lower, right? So maybe the silver lining in the clouds. Sure, we're under the 10. Yeah, we're more than 1% away. But once we stopped there, we didn't pause and then continue to go lower and lower. like say back here where we set a low and then it just kept getting lower and lower. And so at least we didn't do that. But on the other hand, we're not coming back up yet either. We're still a 0.5% under the 10-day, but this is really close. Just be careful with the distance here, how we snapped back really fast from a -3 to being less than a -1 or greater than a -1. Yeah. Got to get back above that 0 line. There's no mean reversion expected at this point, right? We've already reverted, I guess would be a good way to say it. Think of a football field or a basketball court. We're right back in the middle. So the market can make a move either direction now. 3% to the upside, 3% to the downside. I say 3, but we've been hitting that 1.5% average all week. Here's the new year, right? This is January right there. And through most of the year on the upside, we've been doing about 1.5%. That's a good sweet spot for the distance from 10 on the ES. Just maintaining that 1.5% away from the 10-day on the upside. On the downside, however, 2% seems to be the norm, and we kind of overshot that a little bit. But there's your plus minus if you want it. And the thing is, it's a coin toss. Which way are we going to go? There's no edge in trying to look at this and think that we've got more right to go up or down, or that it owes us a move in one direction or another. Because right now it doesn't owe us anything. We're not overbought. We're not overextended. We're not oversold. Nothing. Change over the last 5 days. This is the first day that we've been able to turn it on and see positive anywhere other than the bottom. Now, I know this is really noisy and there's a lot of things on the screen, but the bottom 3 are defensive risk off type sectors, and the top 3 are offensive or risk on, like a perspective on growth versus value if you want to take that route. And then the 3 in the middle is the midline sectors. If we were going to get a flight to safety, then we would expect that bottom 3 to really continue to do good and everything else to do less than the bottom 3 do. It's been an odd 5 days because we didn't get that rotation. We didn't really see that flight to safety, not in here. If you brought up an XLY XLP ratio chart, sure, then you could see the flight to safety, but we didn't really see it materialize in these sectors. We've still got most of the markets above their 200 period moving average, right? Consumer discretionary and energy are the 2 that stand out as not really being healthily above that 200 period, which is the purple line on my chart. Tech barely back above. So really you could throw that one into the mix. Consumer discretionary, tech, and energy struggling to get back above the 2. Everything else either tested and held, like building materials and industrials, or they're just plain doing really well above that 200, above their 50. Even financials looks a lot like staples, healthcare, utilities when we look at the distance from the 200, and it's above its 50, which is the orange line. Maybe another indication that this was just a pullback that went a little too far and shook everybody's confidence, right? That move that we had this week. So you can see the blue line here on the S&P and the NASDAQ. That's the 10-day moving average. Even though we're looking at an intraday chart, you can see how it's been walking down with us. We stayed sideways all week. So we were getting a correction in time rather than a correction in price. It gave that 10 time to come down and get caught up with us so that we can now jump it and get back above it. Same thing with the NASDAQ, the dollar, the 10-year has that same slope. If we were to maybe zoom out a little bit, you can see how the 10 followed it down. So we're there, and it's another piece of caution, right? That we have the 10-year trying to jump back above its 10-day moving average, as we also have the NASDAQ and the S&P trying to jump back across its 10, and the dollar trying to get back above it. So proceed with caution. If the indexes do go sideways today, crude may be a good play. We're already getting that inside day breakout. It could stick. This could grow some legs, get some nice moves. Crude or gold, something, right? If we're going to go sideways, and I like gold maybe too. It's in a squeeze right now on the 15-minute. And if it's not, then it's close to being in a squeeze on the 15-minute. Come out of that squeeze, we could get a play there. If the ES and the NASDAQ are just going to hold the line and go into the close with a whimper, maybe want to look somewhere else. China ADRs are down. The Mag 7 also down. And really, that's what's down. Not much. We're using a benchmark of 0.5% because it's still so early, right? It's only 8:30. We're an hour before the market opens. If you're going to circle back and do this closer to the open, use a 1% benchmark. Let it be up or down, at least a 1% move. But since we're doing it early, I use a half. Looking at things that are up, Bitcoin, more Bitcoin, FNGD, this is a Mag 7 down. There's also a Mag 7 up. So it'd be FNGU and FNGD. The FNGD, which is Mag 7 down, it's getting some flows. Bonds are up. Glad I got out of my bonds. We were in that short, right? Had some puts. Gold miners, mining and metals, real estate. And these, they're not up to that 0.5% that we need, right? So metals, mining, real estate, they're not there yet. Maybe moving in the right direction. The China ADRs are down, but over a 5-day period, they're still up more than 3.5%. So maybe they're just taking a bit of a break, right? If we put those two numbers together, they were up like 4.5%. So 5-day period, 4.5%. That's a pretty good size move. Now we're seeing them take a little bit of a breather. Uranium, pot stocks, agriculture or commodities, food stuffs, and Bitcoin. You don't want to rally on pot stocks and uranium, right? You got to have something better than that. So watch the news because they're hedging for something. They're spending that money for a reason. And I don't know what it is yet. You don't know what it is yet. And look for it to start to fade. There could be a reason that they're hedging that we don't know. And then the reason goes away and it'll just start to fade off. It'll get smaller and smaller and smaller. Now, this is a time-based metric anyways, and it's only for today. So as the day goes by, we expect it to get smaller and smaller. If you continue to see it rise through the morning, it's at 0.7 now. In an hour from now, if it's at 0.72 or 0.75, It's continuing to grow, even though we're getting less and less time. We're running out of time. I know it's not a popular phrase, but the trading day is already half done. It's beyond half done. We're more than half done already. So the clock is ticking on how much time we have for that market maker move. And simply from that metric alone, it's going to start to fade at some point. But if it's continuing to grow, then it shows that they're continuing to add more to that hedge and that there's something on the table. I don't know what it is. There was some airline news a little bit this morning earlier. They were still talking about that CrowdStrike issue, and there was some airlines that reported. Retail's on the table for next week. There's some big earnings out there on retail. And otherwise, I think this is I think it's going to be a whisper into the close. And if it's not, right, we got our range set. So it's the red lines. The range is set. This is what we expect the market to do for the day, is stay inside those red lines and just go into the close and finish it off with a whimper. Now, liquidity resides on the other side of the pivot. So we could get below the red line and then come back in again. We could get above the red line and come back in again. But if we are just going to go into the close quietly, then that's our expectation. If we break that red line and we get away from it, then we're going to go to the yellow line. And of course, if we break that one and we get away from it, we're going to yesterday's low. So level by level. On the upside, if we can get through 5,400, which is a nice round number, it's an options level. It's also the ADR half. Then we'll aim for the ADR full, and we'll then aim for the midpoint of last week. And we can use some measured move tools like 50% and 100% of the move. Right, so there was 50%. It's not perfect, but you can go back and do this on your own. Line it up better. There's 50%. And then there's 100%. 53.32 cog line. Imagine that. 32 cog line. Remember that point of control from the profile that we were looking at. We would have to get back above that 53.32 area. Where is that? 55.32. That'd be back up here. Right? We'd have to get back above that point of control and into that 55.32 area. Can't see that happening today without some really big news. Right? And that's the idea. If it wasn't for this market maker move here, I'd say we'd stay in the red box and we just call it a wrap. But I don't know what the heck they're hedging for. And it's growing. It just got a little bit bigger. So they're not done hedging. Everybody, be careful, be safe. Have a good weekend. I'll see y'all next week.